All right, so let's pick it up here and talk a little bit about tax risk. Now, this is particularly something that's going to, some of these things you could argue are going to change over the generations. But there's no doubt that this can only get worse for the millennials after Gen X and the baby boomers have ducked the bullet on taxes, quite frankly, which we're going to talk about. But the pressure is just getting greater and greater, and we are seeing now in the 2020s so much acceptance that taxes are going to have to go up. So, one of the great risks of retirement planning is tax risks. Historical increases in tax rates on businesses, working people, and retirees, with both state and federal government getting ever more ingenious about inventing new ways to collect tax revenue. So, here's some facts to consider. And again, this is an outdated slide. This was, I think, in 2012. So, said that the national debt then was $16 trillion. We're up to, I think, 23 trillion now. The government just spends continually more than it makes. Forget the 2012 budget proposal. Here in 2021 with the Biden administration, we're doing trillion dollar a year budgets when the government brings in, I don't know, maybe at best a half a trillion, a $250 billion. I mean, it's just way over what we actually bring in. And then you got Social Security and Medicare expenses as well, which are in many ways uncovered. So this is kind of how deep in debt the country is, how much the government needs to figure out a solution. Uh, an interesting concept here. I just want to talk about how big is $1 trillion. I got these different sources. This source is U.S. national debt is the elephant in the room. Vancouver Sun, Canada. They said that $1 trillion. I guess I don't know if these dollar bills are side by side or they're stacked up face to face, but it would reach from Washington to Minnesota in dollar bills to get the $1 trillion. Um, what year was it 1 trillion seconds ago? This is a good idea just to kind of uh, keep the reality of how big $1 trillion is. Um, well, one day ago was 86,400 seconds. 1 year ago was 31,536,000 seconds. A trillion seconds is 31,688 years. Does that give you an idea how to translate that into dollars? Another way of thinking about it, you could spend $31.5 million a year for 32,000 years, and that would get you up to $1 trillion. So, again, just talking about the significance of what a hole the United States government is in. Why is this significant? Because there's possibly only three possible answers to address the debt: spend less, artificially devalue the dollar. That is definitely an effort going on right now, and tax more. Spend less, devalue the dollar, tax more. That's the only three things they can do about all that. So, what do you think they're going to do? Um, And I want to show you why they have so much wiggle room to raise taxes on the millennials. So, do you think income tax is high today? Well, today, the highest possible income bracket you can be with, and I think it's gone up to 39% now. When I did this, it was 35%. That was like the highest federal bracket you could be in. Okay, so in 1945, at the end of World War II, Uh, what would you think was the top federal tax bracket? 1945. That means you got in that bracket, this is how much of the money you have the government's going to take away. In 1945, it was 91%. If you got in that top bracket, the federal government wanted 90% of your money for them. 1972, now that was after World War II, and we did borrow a lot of money in it. At that time, by the way, 1945, the government was serious about paying it back. Over a while, it just got more and more impossible, and I guess they figured out ways to not have to pay it back. 1972, if you were an executive earning $76,000 taxable income, which my dad was back then. I remember my dad did pretty well. We lived in a really nice neighborhood. I remember in the late 60s, my dad bragging how he made $60,000. Like, whoa, dad, that's incredible. So in 72, if you made $76,000 taxable, you were in a 58% bracket. Remember, the highest today is 39. 1972, we had 58. 1986, Ronald Reagan came into office, and he said Congress under President Ronald Reagan swept in office in 1980 on his platform, the power to tax is the power to destroy. They lowered the top federal tax bracket from 50% down to 28%. This is historically what the top tax rates look like. The red line there, I believe, is alternative minimum tax. Um, but the bottom line is look at where we are today at the end of that graph versus where we've been in the past on tax rates. So, my question to you, and really consider this if you're looking at managing current and future taxes, in the future, do you think that tax rates will likely be lower than they are today? Do you think they'll be the same? Or what do you think the chances are that taxes will be higher tomorrow? Now, this next slide I don't want to get too deep into it. It just covers all the different ways you can be taxed. IRA contributions, short-term capital gains, long-term capital gains, interest income, dividend income, qualified Roth distributions. That's the only thing that's 0% tax. So these are all the ways that the government can try to raise. And in fact, in 2013, this was done 39.6. I mean, there's all the ways that the government can try to get taxes to increase, is the point of that slide. So I want to talk to you real quick about how people do save money, how they do grow their investments, and how these investments are taxed so that we have a sort of relative concept of where we're going. Um, so you can tax typically one of four places on the growth of investment. You could tax a contribution, meaning that the money that you've got to put into the investment has already been taxed. So you make $100,000, maybe the government takes 25,000. You've got $75,000 left to invest. That would be taxing. That's an after-tax contribution. They can tax accumulation. So that means that while the money's growing every year, if you're making 10% a year, they can say, oh, well, you made 10% on your $100,000, so you made $10,000. We want a piece of that action. So they could do that. That's another place you can be taxed. Um, they could tax the distribution. So when the gains come out and you cash in and you're now going to live on your beautiful investment that grew, they can tax that, and they can tax the transfer to the next generation. So tax as earned investments are all four. You don't get a tax break for putting the money in. Every year that it grows, you pay the taxes. When you cash in the gains, you pay the taxes. And when it transfers, you pay the taxes. Now, there's a level called non-qualified tax deferred investments. This would be like an annuity that's not an IRA. It's just an annuity, and they go like this. Somebody puts after-tax money into a regular non-qualified annuity. Now, the best part about that is every year that it grows, it is in fact tax deferred. You don't pay taxes on the growth every year. So if you made 10%, you get to keep 10% and you get to compound 10% versus what's taken away from you. However, when you empty that out, your gains will be taxed. Not your bases, but your gains will be taxed. And if you try to move to the next generation, you can be taxed there in a couple different ways. I want to just be clear about this. There's a thing called estate tax that is for large estates. We'll see if it ever comes down again. It used to be for smaller estates. You got to have a lot of money for that. I think it's $10 million to then start to have your estate tax, but it's a very stiff tax. Once it kicks in, you could be taxed 45% of your estate that you're trying to move to your kids. But that's over the first exemption, which is about $10 million. So that's one way. You can also have in IRAs and 401ks, which is the next level. Those are taxed as income, which is way more likely how you will pay taxes on IRAs, 401ks. So let's move to that third level. On an IRA, you're getting a tax break for the money that you put in. So if you put $15,000 in your 401k, you made $15,000 that year. but you're not having to count it on taxes. So that's tax favored contribution. The growth every year is left alone. So whatever growth you're getting, you're not being taxed on annually. You have tax favored accumulation. However, when the money comes out and you cash out of your IRA or 401k, you will be taxed fully on those amounts as an income source. And when those go to the next generation, that next generation will be forced to open those up, start to take money out on a schedule, and they will be taxed on that schedule as well. Now, what we're talking about here, when we use life insurance to save money, it's called a non-qualified alternative. By non-qualified means you can't take a tax deduction for the money going in. You're going to fund it with after-tax dollars. However, while it's growing every year, it is tax favored. You will not receive annual notices on how much your money grew, and you won't have to pay taxes on an annual basis. When the money comes out, if structured properly through policy loans, which is something we will talk more in detail about, but if you do it properly, you won't pay taxes on the gains coming out either. And when it passes to the next generation as a death benefit, it's tax-free money to the next generation, the transfer. So this is a tight way to tighten this up a bit. And we'll talk later, like in a minute here. Let's look at this next slide because I want to talk about whether it's a good idea to postpone taxes till later or whether it's better to take them up front. This is just a funny picture. Is postponing tax a good idea? With IRAs or 401ks, you think you have a great big sandwich, but as that money comes out every year and is get taxed, you find out that the whole sandwich is not yours and the IRS is already taking bites out of it before you even have a chance to get it out of the fridge, I guess would be a good way of putting it. Now, the other thing is that you need to know that most people kill off all of their tax deductions by the time that they do retire. So this is another thing that's working against you. For example, when you're young, you probably have mortgage deductions. You're paying a mortgage. The interest on that mortgage is a tax deduction against your income. So the interest payments on your home mortgage reduce your taxable income. And you can even, and again, I'm not giving you tax advice here. Go see your own tax people. But in the past, we've had situations where a second home is also tax deductible. So interest payments on the mortgage for your second home or condo too can be tax deducted. I think they've been trying to get rid of that. They may have. But when I made these slides, it was absolutely intact. When you are younger, you have child care and education deductions. So several tax deductions and credits are available in the course of rearing children. Let's clear the difference right now. Let's clear this up between what a credit is, what a deduction is. You need to understand this. It's important. A tax credit is a straight annulment of your taxes dollar for dollar. There are situations, I think maybe if you, it might have been like on electric vehicles where you got I don't know, a certain dollar amount that was a tax credit, meaning that if you owe $5,000 in taxes and you have a $2,000 credit, you've just wiped out $2,000 in taxes, period. It's straight dollar for dollar against the tax you pay. A tax deduction reduces otherwise reportable income, which proportionately reduces your tax liability depending on how much of your income the government is taking, depending on the marginal bracket you find yourself in. So don't confuse those two terms. Tax credit is a straight reduction, dollar for dollar taxes. A tax deduction is a lowering of your income by that much, which then proportionately lowers your taxes. All right, when you're young, you also have business and corporate deductions. So those people that own their own businesses have a multiple of pre-tax deductible expenses and benefits that can be paid through their corporation before taxes are due on the income. That could be a company car, it could be your gasoline, it could be 100% of your healthcare costs, it could be meals to entertain clients, travel with a purpose, and also if you put money in your 401k. So those are all things from your corporation that also, when you're in business or when you retire, you probably leave the business. I mean, there's more advanced planning ways to work all this, but typically people leave the business and they lose those too. So as they get older and they're headed for a time where they don't have mortgage deductions, they don't have child care and education deductions, and they don't have business and corporate deductions. And it starts to get a little ugly when they try to you know, well, here's a look at it. It's exactly how this can look. So let's take someone pre-retirement that makes $150,000 gross income, and they're paying 30,000. They have a really big fat mortgage, so they're paying $30,000 a year in a first mortgage interest. They have a second mortgage, so they pay $20,000 in that. They're paying $6,000 in health insurance that they're deducting, maybe through their corporation. Sometimes you set that up, you can deduct all of your health insurance through the corporation. Your business depreciation, it's just another thing that can be deducted. Maybe you have computer equipment or other things that can be depreciated in your business. Your gas and maintenance you're running through the corporation. Check with your tax advisor. I'm not giving you tax advice here. Maybe you do a $5,000 charitable donation. And then you have his and her 401ks. You put $15,000 in each of them. All of that, all of that theoretically is tax deductible. So if you're smart, you made $150,000 gross. You're only paying taxes on 36.5. That's not going to be a lot of tax. Now, post-retirement, let's say you have $40,000 pension. It's taxable. Let's say you take $40,000 a year out of your 401k, not a pension, just your own savings, 401k. That's also not you got to count it. You got to count it as income. You take some dividends and interest off your bonds or something. You got a portfolio getting some dividends and interest. That's also taxable. Social Security, if your income is high enough, 80% of your Social Security is taxable. So that means you've got 135,000 of income, right? 120, 40, 40, 40 is 120, and 15, 135, but 127 is taxable. This is not in comment at all about what changes upon retirement. So let's look at the 401k story. We're taxing the harvest. This is sort of the story of this is, would you rather get a bag of seeds, pay money on the seeds, and keep the harvest tax-free? Or would you rather get a tax deduction for buying the seeds, but when that harvest comes in, you'll have to pay taxes on it? So let's compare. Let's say that you've got $6,000 a year going into a 401k for 30 years. So that's all tax deductible money if you put it through a regular 401k or IRA. So that's 180,000 over 30 years that you did not have to count as income. If you're in a 33 and a third tax bracket, that's $2,000 a year in taxes that you didn't have to pay. So that's $60,000 in tax savings over all those years. Now, take a withdrawal. So let's say all that money, we worked out the math on this at one point. I don't have it underlying here of all the formulas. But we worked out the math that if that was making 6% a year every year, it would grow to $500,000. And if you then just kept the 6% rolling off the top, you're not going to touch the principal. You're just going to take the earnings. You could get $30,000 a year out of that IRA or 401k, and that is taxable. If it was earning 8.1%, you could get $60,000 a year out of it. And if it earned 9.6% a year, you get $96,000. If it was earning 9.6% a year and you put the money in over those years, it would have grown to $1 million after 30 years, and now 9.6 is going to deliver $96,000 a year to you. This isn't about where to find this. It isn't about what causes that. It's just different amounts someone might take out of their IRA 401k. What's the tax cost? Well, now you got to pay taxes on it. If you're in a 1/3 bracket and you take $30,000 out, $10,000 is going to go to the government. If you take 8.1%, you're going to pay $20,000 in taxes on what you took out of your IRA. Now take a look at that. In that case, in 30 years, you saved $60,000 of taxes. And in 3 years, taking it out, you've paid the whole $60,000 back. And the rest, my friends, is gravy to the IRS. That's why they're so happy to give you a deduction now, because they know you'll probably grow the money more than they will. And when it comes out, hey, that's where they get their payday. 3 years, you've given back everything you saved over 30 years, and the rest is gravy at that 8.1%. There's another way of looking at it, and I don't want to go too down this rabbit hole, but if you have a tax deferred strategy, You have tax deferred contributions, gains. Let's see, do we have another slide? Oh, yeah, I'll talk about this in a second. Tax advantage strategy, use after tax contributions, but the gains will not be taxed. So this one on the left, you're getting tax deferred contributions, but your gains will be taxed. And that could be either capital gains on non qualified investments or the income on a qualified investment. That's how that's going to be taxed if you, through wages or tax qualified plans. If you have a Roth or insurance plan, then that is tax-free income. Not a great, totally appropriate slide, but it was in there. I thought we're looking at. All right, so I want to tell you a story really quick about the Swiss bank account. So I have a friend that grew up in Chile, and they had a lot of monetary crises in the 70s and 80s, and they may still be having them. I don't know. But he grew up there, and he told me his parents kept all their money in a Swiss bank account. That's where he was used to seeing the family money being held. So I asked him what, and he told me life insurance. Life insurance is a Swiss bank account. I said, how's that? So he laid it out to me in these terms. Well, what is a Swiss bank account? Why do people put money in it, Bruce? Well, first of all, using the Swiss bank account concept here, it's tax free because if you have a bank account in Switzerland, they used to be totally confidential. Then guess what? They don't tax you because nobody knows about it. Um, they considered it safer than banks in Chile. Chilean banks caved in and stuff. Swiss banks were safer. It was liquid. They could get the money out when they wanted to. It was protected from creditors because no one knew it was there. It got a conservative rate of return. It was a bank, but it was guaranteed against losses. And it was probate proof, meaning that uh, when they died, they just had a named beneficiary, and the account went to the beneficiary, and it didn't have to go through probate courts to prove that nobody owed them money, and they didn't owe anybody money, and they didn't have any creditors. Probate's a whole process in of itself, but a Swiss bank account avoided all of that. So he said, Bruce, what is life insurance? It's safer than the banks. It's tax free. It's liquid to a great degree. You can always get to that money um, if you've let it season for a while. And again, we talked about this earlier. There can be a period on a life insurance policy. I think we talked about it earlier. It's in this series where you do have to wait before it's fully liquid, but typically after a few years, you have 90% of that money available to you to take out and do stuff with. It is protected from creditors. Life insurance typically is. Creditors can't get your life insurance policy. It makes a conservative rate of return, but it is guaranteed against losses. We run ours the same way, and it's probate proof. So, what I want to talk about here is how the policies are built. I want to give you the mechanics of how they're put together. So, you need to think of the life insurance plan as a big bucket with tremendous tax advantages. As we covered earlier, while the money is growing, it's not taxed on an annual basis. When the money comes out, it is also tax free. And there's two things that go into the bucket. One is new cash contributions. So that's new money goes into this bucket, and the compounding interest goes into the bucket. Okay? Now, this is really important. Since it is life insurance, you'll see this word minimum death benefits required. I'll talk about that in a minute, how those are arrived at. But um, the thing I want you to understand is that you have this spigot here. That spigot is paying the cost of the life insurance. This bucket has a hole in it, and you need to be aware that there's a cost to that. That is the cost in exchange for the tax advantages. Now, in the first year, that typically you're going to fund these over 5 years. It's a 5-year funding program. If we wanted to fund it all in the first year, we'd have to have a really big death benefit, and it would be a big spigot. We want to minimize that spigot and optimize it. So what we do is we say we're going to fund it over 5 years. Typically in the first year, the spigot is going to drain about 15% of the money that went in the first year. It's something to take note of in the first year worth of money. But by the second year, if it was drained, that's a fixed cost on that drain. It doesn't increase with how much money is in there. It's a fixed cost for the life insurance. So if it's roughly 15% of what went into the first year, it's now only 7.5% of what 2 years worth of money is. At a third year, at a fourth year, at a fifth year, and now what you've done is it's much more tax efficient. You're probably down to about 1 or 2% cost of that spigot for the tax-free advantages. And as compound interest continues to grow in it, you'll see on your proposal, there's usually some specific charts that show you that like 10 years into the thing, it's like it's paying it, not even 1% of the money is going to the life insurance. So you have to, you're losing some money in the front end, but as you grow it and you fill it and you compound it, the life insurance cost gets very, very, very minimum relative to the amount of growth potential and the tax potential of the money. Now, how much do you have to have for a death benefit? Well, that was determined by three laws that were passed in the 1980s. For what it's worth, TEFRA, DEFRA, and TAMRA, they spell out tax. Oh, forget it. I used to know what they all meant. But they create a corridor that dictates the minimum death benefit required based on the insured's age and gender to accommodate the ultimate aggregate premium basis. What that means in English is we are going to create a minimum death benefit. We want the death benefit to be as low as possible in order to accept the amount of money we want to put in. We want the minimum death benefit corridor required, and it's going to be based on the insured's age and gender to accommodate the ultimate desired aggregate premium basis. How much premium's going in, and that's how we measure that, and that's how we design them. Now, this is a good illustration. It's kind of like what you're doing on this, you kind of like own a rental property, okay? And the building has a cost. There's maintenance costs to the building. If you get one renter in there, it's offsetting some of the costs, but you still got costs. By the time you go through and you get the place full, it becomes a cash cow. And that's what we're trying to do over 5 years on these plans, is get the money in there, minimum death benefit for costs, maximum funding, and we start to have something that really can become profitable. So, what I want to talk about here is another angle. This is important to think about. If the life insurance is a tax-free vehicle, so is a Roth IRA. Roth IRA doesn't have a spigot. It's just all in there making money. So why don't I just get a Roth IRA? Well, let's look at some pros and cons of Roth IRAs. So here's some pros. First of all, tax deferred growth, beautiful thing. Tax-free distributions, super beautiful thing. No required minimum distribution. When you have a regular IRA or 401k, because you didn't pay taxes all those years, there comes a time where the government's like, you need to take the money out. That starts when you're 72 years old. And I have a lot of 72-year-old people and older that are my clients, and they hate taking this money out because a lot of times they don't need to take it out. But the government's going to make them take it out, call it income, and pay taxes on that income. So that's a required minimum distribution. On a Roth, you don't have that because the government doesn't care because they're not they're basically not going to collect taxes on it, so they kind of could care less. And you also have the great aspect that a Roth IRA is, and they're looking at trying to interfere with this, but it because the promise was it would be tax free, it's also tax free to your children. Now, your children, I think, have to empty it out. They're messing with the laws on it, but it is income tax free to them if it's a Roth. The cons are this: cons of putting money in a Roth versus an IRA. I think Roths are better for older people than younger people. Now, first of all, there's a contribution limit. So you can't put unlimited amounts of money into a Roth IRA. Typically, it's somewhere around 6,000 or 6,500, and that will go up over time. due to inflation, but there's a limit. You can't put all your money into it. Secondly, there's a penalty if you take it out early. So you can't get the money out until you're 59 and a half. For some people, that's probably a great idea because it forces them to save it. But for people that might want to use that money for other investments, maybe buy real estate with it, a down payment on a house, you can you can do some special things, but you can't take the money out tax free until you're 59 and a half. You can do some special self-directed Roth IRAs and invest in real estate in a Roth IRA. That's possible, but you can't pull it out and live on the money and spend it until you're 59 and a half because there'll be an early withdrawal penalty. There's income limits. If you make too much money, then you can't even do a Roth IRA. So that can be a problem for wealthier people. And it can also be included in your estate tax calculation. Don't get lost in that. Estate tax is a tax on really big estates when they pass to the next generation. All right, let's talk about life insurance. Pros of life insurance: it also has tax deferred growth, it has tax free distributions, there's no required minimum distribution. It's definitely income tax free to your spouse and children as a death benefit. There are no contribution limits. We see millions of dollars going into these. We see millions of dollars being put into these for tax benefits. I funded one not so long ago that was $2 million going into it. But we see multi-millions going into it. On a corporate level, places you'll never see billionaires, tens or hundreds of millions of dollars, I know in the industry, go into these things. Those agents do very well. There's no income limit. So no matter how much you make, you can still participate in this. There's not a restriction because you make too much. You got a leveraged death benefit. That death benefit, if you have cash sitting in that bucket, the death benefit is always going to be greater than that amount of cash in the bucket. So you always have a leverage up if you do pass away. Chronic illness rider, yes, some policies will actually pay you a long-term care benefit if you need it. All right, now, and it could also avoid estate tax, and that's usually done by just plopping the life insurance into a special trust, which takes it out of the estate. Again, different legal reasons to do this. I am not being a legal advisor or tax advisor in telling you all of this. I'm just letting you know that these things occur, and you would need to see your own advisor to see how that would be appropriate for you. But often enough, life insurance can be removed from an estate if there's going to be an eventual estate tax problem. You don't have to worry about it till down the road. But all right, cost of insurance is a con. Like we mentioned, that little spigot is a downside of it. It has to be medically underwritten. If you're older and you're trying to do this and you already have some major health problems, you might not get insured. That's happened often enough. If you're younger, don't worry about it and you're healthy. Premium load. Oh yeah, this I mentioned this earlier. I wasn't sure where it was in my presentation. Premium load and surrender charges. All right. So premium load is this. In some states, the Department of Insurance charges a tax on premiums going into life insurance or other insurances too. So they have to adjust what the premium can pay for based on the fact that every dollar that goes in, the government is taking a tax on. So that's part of it. If you look at those internal costs on that spigot that we mentioned, a lot of why they're high up front is the money going in is all taxed. So there's a premium load. And the insurance company might be putting some other things into that load in terms of commissions that they pay. They could put into that load other expenses to set up the policy. So when premiums go in, they typically have a little bit of a shave for that. And then there's surrender charges. Surrender charges are basically like, look, we can't set this all up. We can't go through all this trouble to have you dump a bunch of money in and then tomorrow close the account. That's just going to screw up everybody else who's trying to really limit costs and make money on their policy. Costs a lot of money. So what they'll do is they'll say, look, In the first 10 years, if you want to empty the account, just turn around and close it, there could be maybe a 10% charge on that or a certain fixed charge. Actually, with life insurance, it's more of a fixed cost. And then it rapidly declines over the years. That's the cost where if you just close it, you're not going to get money back. It's called a surrender charge. Typically, after 10 years or somewhere in that period, all the surrender charges go away. And any money that's in there, if you want to turn around and just close the policy, you get all the money that's in there. They're not going to withhold anything. But in the early years, they may withhold a little bit if you just try to close it because they've got upfront expenses that they've put into it. So, that all being said, that's what I wanted you to know about all of this. Now, what it's time to do is look at the ledgers, the specific ledgers that I have written for your policy. How's your money going to earn and how are these factors going to play in? But we feel it's really important to get you grooved in on understanding this basically, or going through the ledgers could get a little confusing.